With me here at Mines and Money this afternoon, I'm joined by Ian Williams from Charteris Gold and Precious Metals Fund. Ian, good to see you again.
Okay, thank you.
And look, a big morning for you. As of this morning, you've proven to be the top performing fund across all sectors over the last 12 months.
Yes.
What's the secret? What are you putting it down to?
Well, to be fair, in the top 10, I think 6 of the top 10 are other gold funds as well. So it's been the top performing sector across all sectors this year. Just so happens that our fund is top of the sector.
But without being modest, it is the second time that you've had this accolade in the last 4 years.
That's right, because in 2016, our gold fund was the top performing UK mutual fund across all sectors. And again, about 6, I think, out of the top 10 then were gold funds as well. So it just shows you that there is money to be made in the space, you know. And that this year, trailing year, we're up 52%.
Tell me a bit more about your investment approach.
Okay, we don't buy exploration shares, have no interest in exploration shares at all. We don't buy the big companies like Barrick. We concentrate exclusively on the mid-tier space.
What do you classify as a mid-tier company?
Lowest we'd probably look at is 300 million Canadian dollars market cap,
right.
and the biggest possibly up to 4 or 5 billion. But ones we have bought that were in that space, but that have got up quite a lot, then become virtue of the fact that, you know, we might have bought them when they were 3 billion market cap. They go up 6-fold, and we don't necessarily sell them. So we do hold a couple of big ones, but we didn't buy them when they were big ones. You know, if that makes any sense.
But you're quite heavily weighted towards silver.
Oh yeah, that's really where mostly the outperformance tends to come by having a high silver weighting rather than a high gold weighting.
Right.
We always say to investors, they say, well, you know, how about your fund relative? Want to put some money into precious metals? How about your fund relative to 1 or 2 of your peer group? And we say, look, if your silver has double the volatility of gold, so if you're bullish of precious metals, you should not really buy gold, you should buy silver, because it will go up twice as much if your view is correct. And if you're not really bullish of precious metals, you shouldn't buy either silver or gold. So that's the logic behind it, and it seems to work.
But longer term, what are your expectations for the silver price?
Well, what tends to happen is if gold is going to retest its old high, which is $1,960 or something, just under $2,000 an ounce, what tends to happen, and it doesn't mean it necessarily happens this time, is that simultaneously to that, or within a month or two, silver can also be expected to retest its old high. Now, silver's currently around $17 an ounce, and its previous high in 2011 was just under $50 an ounce. So it's got to triple effectively to retest its old high, whereas gold has only got to go up from 1,500 to 1,900, which is what, 25% rise. So for a 25% rise in gold, if they're both going to simultaneously hit their old highs, silver's going to triple. Gold's only going to go up 25%. So there's massive more upside in silver than there is in gold, assuming that the previous relationships about the way they trade come true next time round, which they may not, but you know, on the assumption that these cycles tend to repeat themselves, and the gold-silver ratio, it would also indicate that silver is very, very cheap, very, very undervalued relative to gold. So if you want to make money, there's a lot of evidence, historical evidence, to suggest that silver has a lot more upside than gold.
And these mid-tier producers that you're investing in, where in the world do you look for?
85% of our fund is in Canadian domiciled mining companies. Because it's silver, a lot of them have mines in Mexico and Central America, but mainly Mexico. That's partly protected by NAFTA, or what Trump has changed NAFTA to. So it's not a bad political jurisdiction. It's not like, you know, some parts of Africa which are decidedly questionable really in terms of political stability. So in terms of corporate governance, you know, Canada's in the top tier along with UK, Australia and US. They're the top 4 jurisdictions for corporate governance. We don't buy South Africa, which is another thing that differentiates our fund. We won't buy any South African domicile mining companies. So they're all in the top, UK, US, Canada and Australia, mainly in Canada, by far and away the biggest holdings. A lot of exposure to silver, but a lot of the gold mines we have are also Canadian gold mines. So that's
just on that point that you made about South Africa. What don't you like about South Africa?
Well, have we got all day? I mean, South Africa used to be the premier gold mining jurisdiction in the world. But that was in the days of Cecil Rhodes and the sort of 50, 60, 100 years after that. So most of the gold's gone. Where South Africa had huge amounts of gold, it's all been dug out, it's all been mined, and what's left tends to be quite difficult, quite deep down, quite expensive to mine. Then you've got problems where the Eskom electricity supply is not particularly reliable, and you've got the black empowerment taking 13% equity stakes there. So there's a whole raft of reasons why there's enough risk in this sector and enough volatility in this sector that you don't need extra risk that's potentially unrewarded risk. So, our fund performance is proved, because all our competitors own South Africa, you see. So I think that one of the things that gives us a competitive edge over our other gold mine funds is that we don't own. And the investors like that as well. When you say to investors, look, we won't buy South African domicile mining companies, oh great, yeah, I like that. Yeah. So.
Do you have any preference for companies which pay dividends?
Yeah, I mean, we obviously prefer. I mean, if they're paying dividends, it normally means, not 100% certain, normally means they're generating free cash flow. Not always, but most of the time. Which is, if they've got to generate the cash flow to pay the dividend. So we prefer, obviously, if they do pay dividends, but most of the return you get is going to be capital appreciation in the shares rather than dividends. But in this era of there was, at the start of October, there's been a big shakeout in the bond market during October. At the start of October, there was $17 trillion of government bonds on negative nominal yields. 17 trillion. So if you're paying to park, and that doesn't include a bank deposit, so if you've got an account with a Swiss bank or something, you've got to pay to park your money. Right? So if you're only getting because people say, dividends on gold mining companies, well, it's only 1% or 2%. Well, if bonds were yielding 6-7%, that would be a valid argument. If bonds are on negative nominal yields, 1 or 2% dividend yield on a gold mining company actually isn't that bad. So, yeah, but the fund, I think, pays about 1%, 1.5% yield across the board. Some companies pay more than 1%, other companies don't pay a dividend at all. But, yeah, we like, obviously, as the shareholders, we like dividends, yeah.
And across the board, gold and precious metals,
yeah.
How would you sum up 2019?
2019, as you can say, so far, year to date, which is those figures you quoted were rolling 12 months. Year to date, all the gold funds, 6 out of the top 10 funds in the UK are gold funds. So they're not tech funds, they're not, the only sector that's run it close are Russian equities. They've had quite a good year. But no, so 2019 has been good, it's been steady, it's not been spectacular. I mean, I think year to date now we're up 35%, 40%. Now, in terms of the space, it can do a lot better than that. It's capable. These mining companies are capable of doubling and tripling. But you need a real proper bull market for that. I don't think what we've seen in 2019 is a proper bull market. It's just, it's a mild version of steady as she goes. Good, there's nothing negative, but equally, I wouldn't say it's overly spectacular.
Are you expecting a bit more of steady as she goes next year?
No, I think it might hot up a bit next year. I think the out-the-box forecast for 2020 is I think we're going to get a return of inflation. And I think that's the wild card that will totally unhinge investors in fixed income. Because look at the US, you're getting, they're printing money now like they have been, but they're really starting to monetize. Deficits out of control. And wages, for the first time in 10 years, are now starting to rise. US wages are rising above 4%. So everything now, as in the UK, as in China. So we're starting to get global wage growth we haven't seen for 10 years. So it looks like the outside bet, still not the consensus mainstream view, is inflation comes back. Now, inflation comes back, this potentially impacts gold and gold shares in an indirect way, because investors will flee the bond market. Because that's the one thing that will decimate your capital if you're a fixed income investor, is investing in government bonds or any form of bonds. If you're getting 1% yield or 2% yield and inflation suddenly jumps to 3 or 4%, you're every year losing money by sitting there. And if you get a shift from a consensus view that deflation's here for the next 10 years to suddenly realization that maybe it isn't, and maybe inflation's on the way back up, that's going to, at the margin, trigger an asset allocation switch from fixed income into inflation-proof assets, of which gold shares and silver shares and gold and silver are obviously up there as the sort of top 5 or 6 inflation-proof assets that people are going to look for. So we think if we get a return to inflation, which we think we will, that potentially is a game changer for asset reallocation. It doesn't do equities any harm. Equities can still go up. But it's death for the bond markets if you get a return of inflation, especially at these ultra low yields.
And should these play out, you could be back here talking to me this time next year, making it two consecutive years at the top of the table.
We might have a proper bull market, where these things double and triple, which is not. It's the nature of the beast. They're quite capable of doing it. But. Yeah, you need something fundamental to start driving it, and we had to try and pick one outside the box. We think in 2020 inflation makes a comeback, or certainly a mini comeback.
Ian, always good to see you.
Okay,
Thank you.
Thank you. All right, cheers.